Okay, good morning. Today you might see we're starting out with the last question we did, and there's a reason for that. That's for Monday. We're going to be finishing up Chapter 7 today. I do want to say we're not doing very much homework in class because I did send out the videos step-by-step that you can use as a guide. But what I wanted to start with was Monday. We ended class with that question. We'll end every class with it, and it's totally optional. You can put down if anything was unclear, if you had any additional questions. So when I went through the feedback from Monday, here's what I heard. I kind of paraphrased it and clumped it together. First of all, a lot of people wanted the last question explained again, so that's why we're starting with it. So we're going to go into that after there. I had a lot of questions about what's the relative sales value method. Again, we went through a homework problem, so we're going to, right after we go through the last question, we're going to go through a relative sales value method example. A couple of people said they wanted more challenging learning catalytics questions, and I'm not sure how I feel about that. We'll see. We'll see. People said they liked the dominoes example. And then, yes, the Domino's car was a Spark, not a Volt, so I stand corrected. Sorry, I knew that at one time and I just forgot. So what we're going to do is we are going to start with that last question from Monday, which we were just on it. That last question was treating the capital expenditure as an immediate expense. What does that do? And right now when I'm looking at the answers, 86% of you are right, so that's great, but it probably doesn't hurt to review it again. So what we're going to do is capitalize versus expense. I just want to talk about this because this is the whole basis of the chapter. We're talking about capitalizing things, and then once we capitalize them, what do we do with them? So when we capitalize something, assets increase. When we buy something like a building, we buy a building, we modify a car into a piece of delivery vehicle. We do something that has long impact. Assets will increase. There is no effect on expenses initially. So when we capitalize, assets go up, no effect on expense. And when we actually do that, when we, say for example, we buy a piece of equipment, we're going to debit the asset and we're going to credit notes payable or cash or however we pay for it. So that's what happens when we capitalize. Okay, so when we capitalize something, we buy a long-term asset that we're going to use in our business. We buy a car, we buy a building, we construct the building, we put in a parking lot, things like that. We are going to capitalize it. Okay, so if we expense, on the other hand, and things that we expense include ordinary maintenance, like changing the tires, putting new tires on the car because they wore out, doing an oil change, repairing a transmission, painting a car, just repainting it the original color or just a replacement paint job. Those are all expense. Those are not capitalized. When we expense something, expenses increase. So the amount that we spent on, say, those replacement tires goes onto the income statement as an expense. Because we have an expense, net income decreases, okay, and equity decreases, okay? So when we expense something and there's no initial effect on assets, what we're talking about is the item itself. So what we see in the journal entry here is we would debit something like repairs expense, some expense, and then we would credit notes payable or cash or whatever it is. But when we talk about capitalizing or expense, we're talking about where do you put the cost of the equipment or whatever we've just purchased, the building, we've built a parking lot, we've put in lighting outside. So we can capitalize it or we can expense it. If we capitalize it, it goes on the balance sheet. It has no impact initially on income. If we expense it, it goes right on the income statement. It increases expenses, it decreases net income, and decreases equity. So our question that we're looking at in Learning Catalytics right now says, treating the capital expenditure as an immediate expense. So it's saying, what if we don't capitalize? What if we should capitalize, but instead we expense something? So the question is, what if we do this in air instead of capitalized? So we take the equipment and we say we're going to expense it. So if we do this, this is why this is a big deal. Net income and equity are too low from the air. So we're saying if we have an expense, we are going to have expenses too high, net income too low, equity too low, because those are the impacts from expensing. And then if we do that, the assets will be too low because we didn't increase them. Okay? So when we're looking at this question, okay, when we treat a capital expenditure as an immediate expense, going back here, we have net income and equity too low because we expensed it. That's what happened. And we have assets too low. So when we look back at our question here, treating capital expenditures as an immediate expense, that is going to overstate expenses because we said we expensed it, so we had expense too high, and net income was too low, and that's understating net income. So none of the other answers are right because it doesn't overstate assets. We're saying we put it in expense, we didn't put it in assets, so assets would be understated. And then our expenses, if we put it in expense, we've got too much expense, so it can't be D, C, or D either. So that's where you get to that, and that's just kind of looking at that difference between capitalizing and expensing. Eventually, when we put an asset on the balance sheet, when we capitalize something, it will ultimately affect net income and expenses, and that's through the depreciation process, which we'll get to a little bit later today. Okay, now, so back to the feedback. So the second and most popular feedback comment I got was, I didn't quite get relative sales value. So yesterday I thought, okay, I'm going to find an example. This is something I thought, oh, it'll take me 15 minutes. But I wanted to find an example of something, so we'll go with what I found. Okay, this house is in Kent. It's on Main Street, 217 Main Street. It's actually used for student rentals. And it was purchased last year, and the company that purchased it is called Black Squirrel Rentals, appropriately, LLC. And they purchased that building and the land for $290,000. Now, let's see, where we go. Okay, and how do I know that? I know that because I looked up the sales record, and down at the bottom, the lower bottom, on April 3rd last year, this transferred from the seller to Black Squirrel Rentals for $290,000. Okay, so when that company went along, they purchased that building. This is the overhead map of it. They purchased two things for the $290,000. They got two things. The first thing they got was they got that piece of land. It's 0.4 acres or something roughly like that. So they got the land and they got the building. Okay, and that's for $290,000. So that's a typical transaction where you're buying two things. You don't buy just the building typically, or just the land without the building. They're together, but it's one purchase price. So, okay, we bought two things. We bought land, we bought the building. Now, coming up later today, those two items are treated differently for depreciation. Depreciation is this process of, if we paid $290,000 for this building and the land, the portion that goes to the building, it's going to be spread out to expense over the life of the building. So let's say they take this house and they rent it for the next 30 years. So they're going to take the amount that they spend on the house and spread it over 30 years. And that process was called depreciation, and that's how we get the cost of an asset from the balance sheet onto the income statement, because it is expense. It's an expense for Black Squirrel Rentals. It's their expense of having that house. They had to pay for it. They're not going to take the whole $290,000 and put it on the income statement the day they buy it, because they're using it over a period of years, and you want that cost to be spread over the years that you use it. So we've got building. Building will wear out, so we depreciate it. Land is never, ever depreciated, forever because it's considered an infinite resource. If there are things in the land that we're taking out of it or timber on it that we're taking off of it, that's a natural resource and that's separate. But when we're talking about we make this purchase, it's 2 items. So what we're going to do here, so just to review, we purchased the house, Black Squirrel Rentals purchased the real estate for $290,000 last year. The land, now I had to make 2 assumptions here. Let's just assume the land appraised at $60,000 and the building appraised at $240,000. Typically, if you do an appraisal, the appraisal is going to appraise out each piece separately, and your purchase price is going to be different from that. It's just the way it is. So we have the land appraised at $60,000, the building appraised at $240,000. If we add those up, that's $300,000. Now they paid $290,000 for it. So we need some way to say how much of that $290,000 is land and how much is building. We can't just say, oh, let me take the appraised value, because the appraised values add up to more than that. So here's the problem. Purchase price is $290,000. So let's say we debited land for the appraised value. Let's say we debit the building for the appraised value, and we credit cash. Problem with this journal entry is those appraised values equal $300,000. That journal entry does not balance. It doesn't work. So we have to say, how can we fix this? We know the cash is $290,000. We have to record the building and land at what we paid for them, not at their appraised value. But how do we allocate the $290,000 between them? And that's what we use the relative sales value for. We have to allocate that some way. So what we're going to do is the land and the building, the total appraised value is $300,000. Okay? So what we're going to do is we're going to figure out that the $60,000 is actually 20% of the total appraised value. I'm just going to take the $60,000, divide by $300,000 total appraised value, get 20%. The other 80% is the building. So I'm just figuring out what percentage, what relative sales value is each one. So we got 20% for the land, 80% for the building. So I'm going to allocate the $290,000 purchase price to the land and the building based on those percentages. So I'll take 20% of the purchase price to land, 80% to the building, and I get back to my original purchase price of $290,000. Okay. Okay, so I've now figured out, so when I go back to do that journal entry, the journal entry is going to be land $58,000, building $232,000. Those numbers are coming from the allocating based on the 20 and 80% of the appraised value. Okay, so, and then the cash. So now our journal entry is in balance now. And that's what we're doing when we do the relative sales value. We have these appraised values that don't total what we paid. We need to allocate what we paid to each piece separately because we do not depreciate land. That's the first thing. So the homework problem you do on this, it's the same idea except there's equipment thrown in there too. So when Black Squirrel Rentals bought this house, we assumed they had the house and the land. But if they had purchased it and it was fully furnished and it had a lot of furniture with some value on it, then they would have had to allocate their purchase price between the land, the building, and the furniture that is in it, because furniture is going to have a different life than the building. And we'll talk about lives and stuff in a minute. So anyways, that's the relative sales value method, and so that's what's going on there. So we're going to get into the new material now. So Chapter 7 homework is due this Saturday. I think there's only 4 homework problems. A couple of them will be a little bit longer, but I guarantee this chapter is going to be better than the inventory chapter in terms of homework. So you've got that, but do allow adequate time. Okay, just my advertisement about the exam. I said this on Monday. Our exam is Monday, Tuesday, Wednesday after spring break. There was no way really to fit it in for everyone before then without having long lines, and it just wouldn't work. So it's Monday, Tuesday, Wednesday, week after spring break. You can take the exam Thursday, March 17th. You have to start it between 9 a.m. and 4 p.m. If you're taking it in the lab, please be aware there are lots of exams the week before spring break. So lines could be long. If you want to take it on the 17th, you're welcome to take it, but you might have to start, wait in line and go early. If you're taking your exam with ProctorU, schedule now for either any time slot to get the best time availability. You can also, if you're in sections 5 and 6, you can also schedule your final exam now, so that you have the best availability, because they do get busy at those times. So the practice exam will become available in the next few days, and study plan is available in the meantime. So if you want to take it on the 17th, you're welcome to. You don't need to let me know, but that's an option if the Monday, Tuesday, Wednesday after spring break doesn't work out. Okay, so Chapter 7. Okay, we're going to start with depreciation today. And I'm going to talk about depreciation, and then we're going to go through an example. And that would be the handout. So if you're online, you would have been offered a PDF. And we're not quite there yet, but that's what we're getting to. So depreciation is this process that allocates our plant asset cost to expense over its life. So if we're Black Squirrel Rentals and we buy that house and $232,000, I forget how much, is allocated to the building, that building, we can look at it and say, well, it's going to last 30 years. So we want to take that $232,000 and spread it over the 30 years that we're renting that building to students, because we're collecting income each month. So we want to have expense that matches it. It allocates cost against the revenue, so Black Squirrel Rental House. The expense is the building itself. We want to spread it over the life against the rental income. Depreciation expense is reported on the income statement. Okay. Accumulated depreciation we're going to get to in a minute. It's on the balance sheet. And land is not depreciated. Once again, I've got a lot more detail in the PowerPoints that are on Blackboard, so you're welcome to download those to get additional notes if you choose. Okay, so we have this depreciation process. That's how the expense of buying these plant assets ends up on the income statement. We don't want to take, if we're Black Squirrel Rentals, we wouldn't take that purchase price and put it on the income statement today, because we're going to use it in our business, our Black Squirrel Rental business, for the next 30 years. Okay, so back to our rental house at 217 Main Street. It's $232,000 on the balance sheet. That was the purchase price that was allocated to the house. So we're talking about just the house. We're going to use that asset for maybe 30 years. How do I know the life? I don't, but we have conventions, and we can say, in general, real estate, like property like this, is depreciated over 30 or 40 years. You, for this class, you will not have to choose a life. That's not part of the skill set. That's done by appraisers. That's done by standard operating conventions. So let's say, for the sake of example, that real estate houses are considered 30 years, which is a reasonable life. So we're going to use that for 30 years. So we have $232,000, and our whole goal now is to say, how do we get the $232,000 into expense over the next 30 years? And that's what we're talking about in this learning objective. Is we're going to look at 3 different ways to take 232. How many different ways can you carve up 232,000 over 30 years? I'll give you just a preview. One method, really easy, is to say, let's take 232,000. This is a gross oversimplification. Let's take 232,000 and divide by 30 years. That's called the straight line method. Okay? Another method that doesn't work with the house, but if we had a piece of machinery and or a copy machine. Copy machines are rated by the number of pieces of paper that go through them, the number of copies they make. The drums are rated like that. So we could do depreciation based on how many copies we made every year, and that's called units of production. And then the last method we do is called the double declining balance method, and it's valid on taxes. It's pretty much double the straight line method, and we'll talk about that. So that's just simplifying it. But anyway, so when we talk about depreciation methods, we're talking about how many different ways can we split up $232,000, okay, over 30 years. Okay, so depreciation, what it's not, it is not a process of valuation. Depreciation has nothing to do with the value of the house or the property, whatever we're talking about, whatever asset we're talking about. It doesn't have anything to do with cash. So these are common misconceptions, so this is what it's not. Okay, now, so we're going to talk, we're probably about 10 slides away from the handout, still going through the basics. How to measure depreciation. We need to know three things. When we do depreciation, we need to know the cost. So that's what we spent on it. That was what our purchase price. Okay. And as we talked Monday, it can be our purchase price. If we're buying a piece of equipment, it'll be the purchase price plus the installation cost plus the shipping cost to get it to us, those kind of things. So we have the original cost. We also need the estimated useful life. Estimated useful life is how long it will be useful for us in our business. It's not necessarily until it wears out. Because let's say, for example, we buy an automobile for our salespeople. The estimated useful life, we may make it 5 years because that's how long they drive the cars. We know the car is still going to be okay after 5 years, but it's done for us. We want a more modern car, so we're going to sell it. So the estimated useful life is not necessarily the life of the asset, it's how long it'll be useful to us. So we will be given, you all, when you do homework, you answer questions about this, you will always be given the estimated useful life. So you need the original cost, you need the estimated useful life, and then you need something called estimated residual value. Estimated residual value is also called scrap value or salvage value, and it's the expected cash value at the end of its useful life. So here you look into your crystal ball, and at the end of the life you say, I think it'll be worth this much. It is not depreciated, and then we have a formula for something called depreciable cost, which is the asset's cost minus estimated residual value. We're going to have a question coming up, and it's going to ask you which of these four items is not needed for depreciation. So you need to have cost, estimated useful life, and estimated residual value. So make sure you have those written down. Those are what you need to measure depreciation. You need the cost, the estimated useful life, and estimated residual value. And there is a question coming up, guaranteed on this. Okay, make sure you have it written down because that question I'm not going to put the answer up. So make sure you have it written down. To measure depreciation, cost, estimated useful life, estimated residual value. This should be a really easy question when we get to it. Okay, cost, estimated useful life, and estimated residual value. Okay, now, this slide changed. The words changed, even though the boxes stayed the same. There are three main methods that we're going to go through for depreciation. The first one is straight line. The second one is units of production. And the third one is double declining balance method. We're going to go through illustrations of all of them. If you look at the slides that are on Blackboard, there's details about each one, but I'm going to show you by doing, so that's where we'll go with that. Some other definitions we'll need. If we have our asset, the plant asset, so this is the equipment, the building, the parking lot, we subtract something called accumulated depreciation, we get the book value of the asset. You do need to know what book value is, so I suggest everything that I'm writing on this slide you're going to need. Okay, so we have, what's accumulated depreciation? Accumulated depreciation is a contra asset, meaning it is an offset to the original asset. So when we have an asset, let's say this house that Black Squirrel Rental purchased, when we have this house, we don't depreciate, we don't reduce the cost of the house on our books. We put all the depreciation in this contra asset called accumulated depreciation, which reduces the book value of the house. Accumulated depreciation is a running total of all the depreciation expense for an asset from the beginning of that asset's life to date. Okay. And then book value. Book value, at the end of the useful life, the book value will be equal to residual value. Okay, let me give you an example of residual value. Let's say we go out and buy a car to use in our business. So this car costs $20,000. Because we want our salespeople to always be driving nice cars, not with rust or beat up, we'll say that those cars will have an estimated useful life of 5 years. At the end of 5 years, we can predict the value of that used car because these are pretty well documented over time. So let's say our $20,000 car after 5 years has an estimated residual value of $2,000. So what that means is we're only going to depreciate the difference between the cost, the $20,000, and the $2,000 residual value. So that would be its depreciable cost. So at the end of the life of that car, when we're done with it after 5 years, the book value of that car will be its residual value, or $2,000. Not everything has a residual value. Residual value, we're looking in our crystal ball and predicting what something will be worth after we're done with it. We don't depreciate the residual value. We depreciate everything else. So some assets have residual values, some don't. It is based on an estimate. It's an educated guess on what that's going to be worth. So that is always provided to you in this class. So you will be provided the estimated useful life. You'll be provided the residual value. If you don't have a residual value provided to you, you can assume it's zero. Okay. When we talk about the book value equaling the residual value, that's at the end of the useful life. So what we're going to see over time, as we use an asset in our operations and depreciate it, accumulated depreciation will go up, book value will go down. That asset's final book value is equal to its residual value. Okay, so what we're going to do right now, we're going to do a question before the next thing we're doing is that handout example. Which of the following is not one of the three things needed to measure depreciation? This is that promised question. We're going to have it open for about 10 more seconds. It should be right there in your notes prominently. Okay. Cost, estimated useful life, and estimated residual value are all what you need to measure depreciation. Okay, so next up, we're going to go through those 3 depreciation methods. You should probably have, you will need those in your notes coming up for a question at the end of what we're doing. Well, not the end, but later. The 3 depreciation methods should be in the margin somewhere. We're going to have straight line, units of production, and double declining balance, which we're going to go through examples of each. Straight line, units of production, and double declining balance. Okay, those are the 3 main depreciation methods. We had a slide on it, just giving you a heads up there. So this handout, which you can access at any time, what I did on it is I took, because these tables are a lot of writing, so I took the numbers, put them in the table, and then you can take notes as we go. So our example, so we're on the page, if you have it, we're on the page that has 2 tables on it, not the one with just the 1 example. So we're on the page that has 2 examples on it. So the top one should say straight line method. Ralph's Pizza bought a used delivery van on January 2nd, 2014 for $13,000. January 2nd is treated just like the first of the year. Depreciation is done on a monthly basis. So January 2nd, that counts as a whole month for January. We don't do depreciation on a daily basis. Okay, the useful life of the van is 5 years. At the end of its useful life, Ralph officials estimated the van's residual value would be $1,000. Okay, so we're given the purchase price, we're given the useful life, and we're given the estimated residual value. So we can do depreciation expense using the straight line method. The straight line method basically says, well, we're going to take the depreciable cost and divide by the number of years. That's what we're doing. So, okay, now on this slide, so you have this handout, you have this table. Table's not here yet, but I'm going to do some notes. So you don't have all the notes on there, but you do have the numbers that are coming. First of all, the original cost on this van, just to remind you from this fax, $13,000. The original cost minus the salvage value or residual value, they're interchangeable terms, gives us our depreciable cost. So that's the formula. Okay, so in this example, our original cost is $13,000. Our salvage value is $1,000, giving us depreciable cost of $12,000. We can only depreciate the depreciable cost. We cannot depreciate the residual value. So that's why we're taking the $13,000 minus the $1,000 residual value. Okay, depreciation expense under the straight line method. You take the depreciable cost, divide by the estimated life. That's it. Okay, so in this example, we're going to take the $12,000 of depreciable cost, dividing by 5 years, gives us $2,400 a year of depreciation expense. Okay, so there we've done all the calculations. That depreciation expense, that straight line depreciation expense formula, depreciable cost divided by estimated life. That's how you calculate depreciation for the straight line method. Okay, so what we did in this table is the first column is the depreciable cost. So this has a 5-year life. We're going to have 5 rows. So the depreciable cost is how we calculated it below. The annual expense, straight line, means the same amount every year. So it's going to be $2,400 every year. The accumulated depreciation is the running total of all depreciation expense to date. So what we're going to see in 2014, okay, is we have just, oops, okay, we have just the 2,400, okay? But for 2015, we have last year's 2,400 plus this year's 2,400. Now for 2016, we're going to take the 4,800 and add this year's 2,400 to get 7,200. So every year we just keep adding $2,400 to the year before. Okay. And then the book value up in the right corner, that's our original cost minus our accumulated depreciation column. Straight line depreciation, very straightforward. It's one of the most popular methods for companies to use for their financial statements. You know what we said last week? Your inventory method that you pick for your financial statements has to be the same as what you do on your income tax return. Okay. Depreciation is not the same. You can and should use different methods for your financial statements than for your tax return. So straight line is the most common depreciation method for financial statements. So it's acceptable under generally accepted accounting principles, and it's very straightforward. So straight line, very, very easy. You're just taking the same amount every year. Accumulated depreciation builds up every year. We just keep adding this year's depreciation to the running total from last year. And at the end of this, we can see our book value at 2018, that right-hand corner one, that's the residual value. Residual value at the end of an asset's estimated useful life will be equal to its, the book value will be equal to residual value. If we didn't have a residual value, the book value at the end would be 0, but only if we don't have a residual value. Okay, so straight line, not bad at all. That's the easy one. The other ones we need to do a little bit more work to get to them. So we're moving on. So we have the straight line method was the first one. Remember, there's a question coming up asking you which one of these four methods is not a depreciation method. So straight line's one of them. The second one is units of production, which is what we're doing now. So units of production. So we have that same van, but units of production says, let's frame our depreciation around the use of something. It does our van wear out based on use of something. And with motor vehicles, you can say, well, yeah, the van wears out. The more I drive it, the more I'm using up the van. Just like a copy machine, the more copies you make, the more you're using it up. A house or a building can't be used for units of production because it's not making something, you're not consuming something like driving a van for miles. So this one, units of production, we have our van. We bought this van on January 2nd, 13,000. That hasn't changed. Now, it tells us we have an estimated useful life of 5 years, but now it says, or 100,000 miles. So the estimated useful life under units of production is going to be the number of miles or number of hours, number of copies, however we do that. At the end of its useful life, we have the estimated residual value still $1,000. So we haven't changed the dollars from the last problem. We're just putting some miles in. The van traveled 15,000 miles the first year, 30,000 the second, 20,000 the third, 25,000 the fourth, and 10,000 miles. So all those miles add up to be 100,000. So now it's saying let's prepare a schedule of depreciation expense per year using this units of production method. Okay, so those are our facts, and this is the second problem on the one page of the handout. Okay, so what I'm going to do is I'm going to show you how you calculate this. So you have the table with all the end numbers. Depreciation per unit of output is going to be our original cost less the residual value divided by the estimated useful life in whatever production method we're using. So this is miles. It could be hours. It could be copies. Miles is a pretty common one. We could do units of production for motor vehicles pretty easily. So again, we're taking our depreciable cost on top, which is our original cost less our residual value, divided by this total life. Now life is measured in miles. So what we're getting is 12 cents a mile when we do that. Okay, again, looking at our table, what's helpful to know is that the second to last column, accumulated depreciation, that is still this running total of all depreciation expense to date. So it's all of it up to that point, so adding each year. And then the final column, book value, is our original cost minus accumulated depreciation. Okay, so our table is very similar. We have another column now called rate per mile. So what we're going to do, now that we have our 12 cents per mile, what we're going to do is we're going to take the miles driven in year one, they tell us they're 2014, times 12 cents. In 2014, we drove 15,000 miles times 12 cents, gives us depreciation expense of $1,800. So then our $1,800 is our accumulated depreciation for the first year, because we don't have anything else other than that. And our book value is the original cost of $13,000 minus the $1,800. Okay? So the book value is our original cost was $13,000 minus our accumulated depreciation of $1,800. So that's year one. Okay. Year two. Year two, we have 30,000 miles driven times 12 cents is going to give us $3,600. And the $3,600 again is the 12 cents times the 30,000 miles driven this year. Okay, now our accumulated depreciation is going to be the last year's accumulated depreciation of $1,800 plus $3,600, so it's going to be $5,400. So we're taking last year's ending balance of accumulated depreciation, adding this year's depreciation, and our ending book value will be the original cost of $13,000 less our accumulated depreciation of $5,400. Okay, so we're going to keep doing that. So the next year, okay, so we're going to do that each year. So I'm not going to walk through every year. Same thing. It's going to happen over and over and over. So the big thing with the units of production method is calculating your depreciation per unit of production. So you take your depreciable cost, which is the original cost, less the residual value, dividing by the total life in units of production. And you get the depreciation per unit of production, in this case per mile, and then you drive so many miles, that's how much depreciation you take. Okay? So units of production is not bad to do. It takes a little more work than a straight line. You can only use it on things that have that are used up. There's a ready connection. There's miles, there's hours, there's copies, something like that. Okay. So that's units of production. So remember, I said you're going to have a question coming up, which of these four methods is not a depreciation method? So you have straight line, you have units of production, and then the third one, the third and final one we're going to do is called double declining balance method. And that's on the reverse. That is the method that has its own page. Okay? Now, we have to do a little bit of heavy lifting on double declining balance method. It's a little more challenging than the other two. So we'll walk through it. So same set of facts. We don't need any new facts for double declining balance method. We know our original cost of this van was $13,000, has an estimated useful life of 5 years. It has a residual value of $1,000. The 5 years is estimated given to us. It's how long it's going to be useful to us in our business. The 5, so that's the 5. The residual value is estimated and given to us. So then we go on. Okay, so same table. The only thing is we substitute our second column now. It's called a double declining balance rate or declining balance rate. But the calculations are going to be a little bit different on this. First of all, the formula for the declining balance rate or the factor for a double declining balance rate is going to be 2 divided by the number of years. Why is it 2? Where did I get 2? 2 is because it's double declining balance method. Okay, so double is 2. So it's always 2 divided by the number of years. We're always using double declining balance method in here. Okay, now I'm going to take my 2 divided by my 5-year estimated useful life, and I get a factor of 40%. So let's start with this. so the first year, 2014, okay, my beginning book value is $13,000. Okay, where did I get $13,000? That's the cost. This is the only method that does not take the residual value into account in the early years. You'll notice we are not worried about that $1,000 when we first start this problem. So we're taking the beginning book value. Book value is always our original cost less our accumulated depreciation. When we start, we have no depreciation. Okay, so we have $13,000 as our beginning book value, times this rate of 40%. We got the 40% rate down there at the bottom. It's always 2 divided by the life in years. So 2 divided by 5 is 40%. So I'm going to take $13,000 beginning book value times 40%, and I get $5,200. Okay? Now, my accumulated depreciation is a running total of all my depreciation to date. In the first year, it's just $5,200. Okay, and my book value is the original cost less accumulated depreciation. So my original cost was $13,000 minus $5,200 is going to give me $7,800. Okay, so book value is always my original cost, $13,000 minus the accumulated depreciation, $7,800. Okay, so now going on to 2015. So 2015, our beginning book value is last year's ending book value. So that $7,800 that we ended last year with is what we started 2015 with, times our 40% rate, and we'll get $3,120. That's our depreciation this year. So then we're going to add that to last year's accumulated depreciation balance. So we'll add the $5,200 plus $3,120, and we get $8,320. And then my book value at the end of the year is my original cost of $13,000 minus $8,320, or $4,680. Okay, so we keep doing that. And right now you're saying, this isn't bad at all. This is, you're going along making the same calculation. There is a little glitch at the end, okay? So we're going to go through 2016. It's going to work the same way, and so you've got it. So we're taking the ending book value from last year, multiplying by the 40% to get our depreciation expense this year, adding it to accumulated depreciation, etc. Okay, so we're good at the end of 2017, okay? Now, something to remember, our book value can never drop below the residual value. Just as a reminder, our residual value in this problem is $1,000, okay? So right now, I'm looking at my ending book value, and it's $1,685. That can never go below $1,000. So we know that it cannot go below $1,000. At the end of asset's useful life, the book value has to be the residual value. So right now I could do this, I could finish this up right now. I could put 1,000 out in that final column as the ending book value and then work backwards. And that's essentially what we're doing. Because the double declining balance method does not take into account the residual value in the early years. We're using $13,000. We're just using it. But every year we have to start checking the last few years to make sure our ending book value does not drop below the residual value. In this problem, it doesn't drop below the book value until the last year. Depending on the numbers involved, you could have this happen in year 3 or 4. You can never go below there. Once you hit the residual value, you're done with depreciation. So what we're going to do in this year, let me just start this year as $1,685 times 40% gives us, wow, it doesn't give us $685, but how do I know it's $685? I know it's $685 because my residual value is $1,000. I had a book value of $1,685. If I took $1,685 times 40%, I'm going to get a different number. So my ending, the last depreciation, is always a plug figure. So how I get it is I say my last book value is 1,000. What do I need to do to get to 1,000 from 1,685 last year? And that's $685, and that's how we're getting it. So that's the little glitch about the double declining balance method. You have the factor, but at that, you don't use residual value in the early years under double declining balance method. It's the only method that doesn't use that. Okay? Fortunately, I'm trying to think on your homework. I know at least one problem you only do the first year or two, so it's easy. You don't have to do this. This isn't something that you'll have to do a lot, but I wanted to show you why the residual value is not used in the early years in double declining balance. It comes into play in the end. Okay, so now you see why I wanted to give you a handout, because there's so many numbers to write. Okay, now, so we're going to talk about, we just went through 3 methods, and you have them in front of you. If you look at the 3 methods, the amount of depreciation per year, the method that produces the most depreciation a year in the early years is double declining balance method. Double declining balance method, it is desirable for tax purposes in most situations. And the reason it's desirable for tax purposes is it provides the fastest tax deductions. Would you rather have a big depreciation deduction or a lower one? Well, you'd rather have a bigger one, because if you have a bigger tax deduction, it decreases the cash you pay out, which in turn, that tax savings can be reinvested in the business and earn more money. So all other things being equal, you want the bigger depreciation deductions in the early years. Okay, so companies will choose one method for their financial reporting. Under U.S. GAAP, it's going to be typically going to be straight line, but they could use straight line, units of production, or double declining balance method. So companies choose one method for financial reporting. And typically companies choose straight line. But then on their tax return, they choose a different method. And taxes, actually your taxes, when you do taxes and you have depreciation, it's not actually, the method that you use is not called double declining balance method. It's called the modified asset cost recovery system, MAKERS. And it's like double declining balance, just a little bit different, but that's why we go through double declining balance. Okay, so couple more things. If you buy something in the middle of the year, you have to adjust to depreciation. You have to compute depreciation for partial years. Basically, you compute the depreciation for a full year, and then you multiply it by how many months out of 12 that you had it. So that's it. It's not a big deal, but if you have a partial year depreciation, you're going to have to make an adjustment that first year, and the last year if you don't own it the full year. I think you have one homework problem that has a partial year. So you figure out under straight line what the full year would be, and then if you're going to have it 5 months, if you purchased it in July or August, you have 5 months. You could go 5 months out of 12 times that full year. So that's the adjustment for a partial year. Okay, now, remember I promised you this question? Okay, going to put up a question. Now just on your handout, think about, we've got all 3 depreciation methods listed on your handout, right? You've got straight line, units of production, and double declining balance. Those are the 3 major methods we're using. I'm going to get to an example here coming up, but first we'll do a question. Which of the following is not one of the 3 main depreciation methods? Okay. Okay, this one, you've got the handout. It lists all 3 methods. There should be no reason to get this one wrong. I'm going to close it in about 10 seconds. Time is ticking. Last opportunity to get your answer in or to correct your answer, as the case may be. We just went through each of the three methods. Okay, and of course, residual value is the item that's not a method. We went through straight line method, we went through units of production, and we went through double declining balance method. Okay, what we're going to do now is I've got another little story about Caesar's Palace. Okay, so this is Caesar's Palace in Las Vegas, and they have lots of property, plant, and equipment. Caesar's Palace in Las Vegas is composed of 6 towers, and one of their towers, the Roman Tower, they renovate about every 15 years, and not all at once. So they'll take one tower out, renovate it, and then put it back in. So the Roman Tower has 500-600 rooms in it, and they undertook a renovation last year, and it just opened up in January this year. So they renamed it the Julius Tower so they could rebrand it. But what they did with the Roman Tower is they renovated every room, freshened it up, modernized it, put some high-end things in it. They did the bathrooms as well. They did all new fixtures, flooring, walls. This is a major renovation, and it looks like when you do the math, they spent $75 million on this renovation, which would be thousands and thousands of dollars per room. So they added probably in the renovation, they had $75 million for the renovation. Not only did they renovate every room, but they also added something like 20 more rooms. So this is a major undertaking for them. They had to close the tower to do it. They renovated it, and interestingly enough, these renovations are done about every 15 years. So when you think about how they're going to depreciate the renovation, 15 years kind of makes sense because they will be using these rooms for 15 years until they do a renovation. Now, a renovation is different from let's just put slap a coat of paint on the walls. They did all new furnishings. They did new flooring. They did some major things to bring this into a new life because they really couldn't, for their purposes, they couldn't rent those rooms anymore because they were so dated. So that is different from taking a paint can and doing a fresh coat of paint. That's normally repairs and maintenance, but this is a major renovation they did. Okay, so that we're going to do a series of questions here. Okay, so for the cost of renovating that Roman Tower is now the new Julius Tower. Would we capitalize those costs or expense it? We got $75 million we put into this renovation. Okay, again, when we talk about capitalizing something, we're doing, capitalizing means that this is going to significantly extend the life of an asset, significantly improve it, and certainly with our renovations of these rooms, those rooms were at the end of their useful life. Even though the tower wasn't crumbling or anything, those rooms were at the end of their useful life. They could not rent them out anymore. With the renovation, by the way, they're charging about $20, $25 more a room as well. So when we talk about the cost of this room, this is a very high-ticket renovation, $75 million. These renovations will last for the next 15 years, and they significantly extend the useful life of the property, okay? So with that in mind, would we capitalize it or expense it? Okay, your last chance here. Big ticket, big dollars, significantly extending the life. Okay, so when you're deciding whether you expense or capitalize this, remember if you expense, you only expense for things that are ordinary repairs, okay? So if you've got to fix a leaky faucet or you have to paint a wall, that's going to be expense. Capitalize is we significantly extend the life of something, we alter the purpose, we add new rooms, we add a new wing. Those are all capitalized. I'm going to close this in 5 seconds. Okay, so those are capitalized, okay? Because it significantly extends the life of that tower. That tower was at the end of its useful life. This is a pretty major overhaul, giving it another 15 years of life. Okay, next one. So again, now the renovation costs, okay? Renovation costs for Caesar's Palace. We said they would be capitalized, not expensed, okay? So we're renovating the hotel, the building, so which account would we use? Okay, so when you're answering lists, let's talk about it. On the balance sheet, think about what statements, what accounts are on the balance sheet. On the balance sheet, we only have assets, liabilities, and equity, okay? So right off the bat, I look at this. On the balance sheet, you will never see an account something expense other than prepaid expense, but ignore that. But you will not see things like repairs expense or hotel expense on the balance sheet. Those would be over on the income statement, okay? So right now, we're down to choosing between B or D, building improvements or land improvements. Land improvements are things we do to the land. So they're things like parking lot, exterior lighting, fencing, outdoor sprinkler systems. Those are all considered land improvements, okay? Now, building improvements, on the other hand, are things that we do to the building. So I'm going to close this in 5 or 10 seconds. When we renovated the tower, we were renovating each of the rooms in the tower. That's what the renovation costs were for. Okay, so that is, of course, building improvements, okay? So we're going to do a couple more of these. Let's go. Okay, so land improvements. So when we talk about land improvements, so now we're leaving Caesars and just talking in general. Land improvement, let's say our land improvement is a parking lot, okay? Is land improvement subject to depreciation? Now, I had a, oh, this is interesting. Okay, my question on the screen is different from the question that's on your, wow, okay. So I'm going to tell you what the right answer is because I've messed this one up. So what happened, I think, was I wrote the original question the way you're seeing it. And the way you're seeing it is land improvements are not subject to depreciation, okay? So see what I did for my answer here. Okay, so what you're seeing in your learning catalytics is land improvements are not subject to depreciation. Well, after I wrote that, I was like, that's really weird, worded weirdly. So I fixed my PowerPoint, but I did not fix learning catalytics. So here's what you're going to do. We're going to close this question, but right now, this question, you need to put false. You're answering the question that's in learning catalytics. So let's make sure everybody puts false. I'm not going to show it on the screen because it's going to show the opposite answer. So this question is false. False, false, false. I'm going to close this. Come on, we're down to 2% with true. This is false. Ooh, 100%. Okay. Anyone else want to? I think we're going to go with it. Okay. Okay, cool. So let's ignore that one now, and let's go to the one that's on the screen. Land improvements are subject to depreciation. The way I've got it written on the screen here, do you want to mark that I fixed that one between classes, please? Land improvements are subject to depreciation. Absolutely, absolutely, that is true. Okay, so land improvements are subject to depreciation. I'm sorry, it was just the way that was written. I didn't like that, and I fixed one and not the other. So we depreciate a parking lot. A parking lot will wear out. Lighting will wear out. We do not depreciate land. Okay. Okay, let's try another one. These are. Let's see if they match before I put it up here. The accumulated depreciation account is an income statement account. Oh, okay, so that does match. Okay, so accumulated depreciation account is an income statement account. So let me see if I can give you some hints. Accumulated depreciation is a contra asset. Okay, so it offsets our asset. So we think about, is an asset, does an asset go on the income statement? An asset shows up on the balance sheet. An asset is, balance sheet is assets equal liabilities plus equity. So when we have assets or contra assets, they go on the balance sheet. So on this particular one, we are going, it's going to be false. So you want to make sure you get your answer in there. Okay. Accumulated depreciation is a balance sheet account. Okay. So it is not in the income statement. Income statement has things like revenues and expenses. Balance sheets have assets, liabilities, and equity accounts. Okay. So let's do. Okay. So another one here, book value. Book value equals the cost of the asset less the total accumulated depreciation. Okay, book value equals the cost of the asset less the total accumulated depreciation. That is true. I do want to say something. You don't even need the word total. Okay, total is kind of redundant in that sentence. The book value is always our original cost less the accumulated depreciation. Okay, total just kind of emphasizes that accumulated depreciation is just running total. Okay, so. Okay, and let's see this one. Okay, I think this one's worthwhile as well. Okay, at the end of its useful life, the book value of an asset must be 0. True or false? Okay, let me help you on this one. The end of its useful life, the book value of an asset must be 0. The book value of the life actually has to be its residual value. If its residual value is 0, that's good, but, I mean, that's fine, but it has to be its residual value, which is not necessarily 0, okay? So, we are going to close this one, make sure we've got false there. The book value at the end of life is the residual value. Okay, and then I put out one question we're going to end every class with. If you have a question for me, you want to put anything in there, fine. The last question does not impact your score at all. And some people, I am emailing you back based on what you put in that field too. So you might get an email from me. So that's it for class today. I will see you on Monday.